Hi everyone, my name is Angela Seresny and I'm co-founder and CFO of Orchard, a technology company that enables loan originators to distribute their loans to a diverse set of institutional investors. That distribution channel is known as marketplace lending, and it's primarily associated with firms like Lending Club and OnDeck Capital, who you may be familiar with as they went public last year in December. So I'm excited to speak with everyone here today. So why am I here speaking to all of you? We believe that marketplace lending can add significant value to all of your businesses. You may be thinking that those firms I mentioned earlier, what's going on with them, isn't applicable to equipment lending. And it's true that we haven't seen a lot of activity in this space to date, but we believe that marketplace lending can add significant value to your businesses by adding efficiency to your funding sources. So today, we're going to talk about Orchard, my company. We're going to talk about marketplace lending and how it's being leveraged today. And we're going to talk about some firms who are already leveraging marketplace lending and how they're doing it. So, my background is in traditional finance. I discovered marketplace lending while I was working in the depths of bank lending. I was running small business underwriting and analytics at Citibank at the time. And prior to that, I was running consumer underwriting at American Express. So I discovered Lending Club in 2011. And for those of you who aren't familiar, Lending Club is an originator of consumer loans, which on its surface is not a very unique concept. But what makes Lending Club unique is, one, they distribute 100% of their loans, taking on no balance sheet risk. Secondly, they distribute those loans at the loan level. So they allow investors to pick and choose which loans they want to invest in based on their credit profile. And lastly, they make their entire loan book and loan performance history publicly available to anybody on their website for investors to analyze. So, for the first time in modern banking history, I, a retail investor, was able to invest directly in a loan to a borrower with full transparency into their credit and financial performance and data, the exact same data that was available to me running an underwriting department at a bank. So, once I found this data online, my first instinct was to build a credit model and start investing money. And so I did that. And I loved the diversity that this brought to my own personal portfolio of investments. And I also loved the yield. I had a few other friends, some of which are in the audience today, who were also investing in this space. And we were fascinated by the growth of Lending Club and what we saw happening. As we began to research it further, we realized that what was going on here was actually revolutionary. So we continued to invest our money. We started writing about the industry and writing about the credit and analytics information that we were finding on Lending Club's website, on our website, on our blog. And in 2013, Orchard presented at the first Marketplace Lending Conference here in New York. While we were there, we learned that our enthusiasm was matched by that of the institutional investors. They, like us, loved the asset class for its yield and the diversity it brought to their portfolios. They also liked the idea of being able to buy the individual loans that matched their credit portfolio, or their credit box. So, we began talking to them, learning more about their businesses, the institutional investors. And what we found was that despite how much they liked this asset class, they lacked the technological infrastructure to deploy their capital at scale and manage the loan books that they'd be acquiring from these online originators. So we built Orchard with that in mind. The product that we built enables institutional investors to deploy their capital at scale in these online powered marketplaces. So we built our product, we experienced rapid adoption, and started receiving client feedback. As we spoke with our institutional investor clients, we kept hearing a similar theme. They wanted to deploy more capital, and they wanted more diverse assets in addition to the consumer loans that we connected to through the online platforms. So we started researching ways to bring on more diverse and interesting supply for our institutional clients. In order to do that, we went and met with various loan originators in all types of businesses, some like you guys. We started hearing the same theme when we spoke to them as we heard with our institutional clients. They liked the idea of adding a distribution channel, a direct distribution channel to their business, but lacked the resources to build that distribution channel to be able to scale. So the next product that we built was a distribution tool that enables existing lenders to distribute their loans directly to investors without having to build that technology. So it makes sense that investors want access to these loans, but why should originators distribute in this way? As many of you have probably witnessed or maybe even experienced, being beholden to a single source of funding can be difficult for your business and could in some cases be a recipe for disaster. If that source of capital dries up and is no longer an efficient way to raise funds, like what happened to the commercial paper market in 2008, it can cause someone to go out of business or to have to change their business model overnight. The idea of adding marketplace lending as part of a funding strategy helps to solve that problem. Banks are great to borrow from as long as the products that you're issuing meet their requirements, which generally require lower credit risk. The securitization markets allow you to move the loans off your balance sheet, but without full capital release, and can be a resource-intensive process. Marketplace lending enables you to go directly to investors, which allows you to have flexible pricing, which enables flexibility in times of crisis. So, marketplace lending is a great addition to a funding structure for a loan originator. It's fast, and it's flexible, and it's transparent. A great example of a firm who has been able to be successful in this way and with this funding model is Mainspring. So I'd like to introduce Rob Snow, the founder of Mainspring, to the stage so we can discuss his business, his thoughts on marketplace lending, and a partnership that we've recently announced between our two firms. Thanks. All right, Rob, please introduce yourself and give us some background.
Absolutely. Thank you, Angela. So I came into marketplace lending, through a variety of finance and banking jobs where I started my career at the stodgy old New England Bank. I was at Bank of Boston for about 11 years, and I went from there to E-Trade, where I ran all the lending businesses. So I've seen the market from a variety of different spaces, where the traditional banking model, the non-traditional online banking model. And then over the last 8 years, I've been advising banks and ultimately getting involved in various specialty finance companies, which really culminated a couple of years ago when, along with institutional investors, made an investment in Blue Ridge Financial, which is a small ticket equipment finance company. So, background really comes from a variety of sources, but I would say most of it was around traditional lending, traditional credit granting process, and frankly traditional capital raising in terms of where we got our funding and how we grew the business.
So why did you decide to start a firm that distributes loans, and what attracted you to that financing strategy?
Sure, I think and really where the idea from Mainspring funding came from. And Mainspring is affiliated with Blue Ridge Financial, the equipment finance company, and it handles all of the marketplace lending and some origination activities, online origination activities. And we're looking at other, either products and building out, acquiring companies underneath the Mainspring brand. Why we're doing what we're doing is the traditional model that we had at Bluebridge was originating loans and selling them to banks. That model is, I would say, kind of the old-fashioned way. We send out loan tapes, we send out loan files. People look at them and they buy some and they don't buy some. It's not really scalable, and there's a small segment of the market that that looks at those loans and will make a decision to buy or sell, and depending on those decisions, that really reflects how quickly we can grow a company. One of the things that we saw, and this goes back a couple of years following some of what Angela talked about with Lending Club and Prosper, we saw the introduction of institutional capital coming into looking for loan assets, and frankly, that was a source of capital that didn't exist before. So when we looked at our business and thought about how we're going to grow the business, it would have been silly for us to ignore sort of the influx of institutional capital that, prior to that, it probably played in the fixed income market, but it never really played in the loan assets. And one of the things that we saw, it actually started when we were out raising institutional equity for a client. Everyone was saying, well, how can I buy the loans? What do you mean, how can you buy the loans? I can send you a loan tape, and they say, well, I don't really want a loan tape. I want a transparent marketplace where I can see the loans and know what other people are paying for them and understand the pricing. So really for us, and why we got involved with Orchard and in the marketplace, was access to the capital, but really to give us an opportunity to significantly grow our business by attracting new investors.
So what do you think are the important factors to be successful with this type of model?
Well, I think the first thing is really transparency, and the investors. And so as part of this process and partnering up with Orchard, we've had a lot of conversations with institutional investors, and really the reason they like the marketplace is because of the transparency, both in terms of historical data, but also understanding what's happening with other buyers in the marketplace. So the availability of data is very important to the investors. I think the other key factor is, and this is how we think about it from a funding strategy, the investors are looking for yield. So yield is an important consideration for any of the investors on the platform. So when you think about products and you think about which loans you put out on the platform, I would say there's generally a bias within the investor community towards yield. So those are probably the two big factors.
Yeah, you mentioned transparency, and that's something I know I touched on a little bit when I was speaking. I just find it fascinating how, at this point, like the difference between, even back in 2008 when I was working at Amex and we would talk about buying a loan portfolio from another credit card issuer, the amount of work that it took to analyze what was in that loan tape, like going to the mainframe room, and we had to send. I remember we were looking at a portfolio in Australia, and we had to send someone to Australia to look at the data. And now it's the truth is that's really unnecessary given how technology has evolved over time, and the availability. It's cheap and easy to transmit that kind of data and assess it, in a way that really doesn't require those types of resources. So I think, that's kind of an interesting transformation, and I see a lot of these investors, investing in analytical teams who can run those kind of big analytic projects on large loan books. So.
I would echo that. When you think about and how we use the platform today, we'll look at loans that we want to sell. We still maintain relationships with other investors, and thankfully we're no longer shipping loan tapes, although there was a time. But it's really as simple as looking and saying, we think this loan, with these attributes, will meet the investor demand, and upload it to the Orchard site, and an investor's able to make a buy decision very quickly. So it really speeds the flow of loans that you're able to sell, as well as gives you a great way to kind of manage your balance sheet.
Right, so you mentioned Orchard. I'd like to talk a little bit about our partnership. So I think we met last year, and as I mentioned earlier, we were sort of on this quest to learn about the traditional lending space and what was happening in on the loan origination side outside of the sort of online marketplaces like Lending Club and OnDeck and Prosper. People are familiar with them. And so when we met you, I think that we really saw a way for us to be able to leverage our two different competencies. Orchard being a technology company, we were able to build the tech so that Rob's team, instead of emailing those spreadsheets to the investors, can actually put it in one place, and then it's automatically on our portal for our investor clients to be able to see, and for us also to be able to alert the different investors that it's there. So if they want to go and review the loans manually, they can do it, or to set up some sort of automated systems as they get more comfortable with the assets. So that in some cases, like I said, if they have an analytics team that knows which loans they want to buy, they can do it without having to go in and pick and choose. So
no, I think that's exactly right. Our decision to partner with Orchard really came down to the fact that we know how to make loans, we know how to approve loans, we know how to collect loans. The distraction of building a technology platform that was a state-of-the-art platform that frankly had other investors already on it, the time and energy associated with that was a lot more than we wanted to spend as a company. So really, the partnership with Orchard allows us to do what we do best, which is making loans, and takes advantage both of the technology that Orchard's invested in, but also take advantage of the investors on their platform. So it's an opportunity, one, for us to make our loans available to existing investors that are already participating in the marketplace, but also to take some of our offline investors and introduce them to the marketplace and give them the ability to use some of the tools that are out there.
So what data and information do you think is most important for you to be able to manage your business and a distribution business?
A lot of it, in terms of managing the distribution business, it's really understanding, the attributes, all of the attributes of the loan, whether it's the scores associated with the loan, whether it's the time in business, the industry, the equipment, and really how then the marketplace looks at those. So you get real-time feedback in terms of, okay, this loan that has a yield of X, we're able to sell that at Y, and that investor's buying that, because they're looking for a net yield of Z. So it allows you to really create some analytics around, real time, what you're originating and where you're pricing it in the marketplace to your customers, and then where the back-end execution is, which, prior to using the marketplace, the feedback relative to the execution takes a lot longer, whether it's selling to banks or whether it's securitizing. Your execution is pretty far removed from your decision to price and fund the loan. And so to be able to track that and adjust that real time, relative to the risk attributes of the loan is hugely important.
So how do you see the future of equipment lending in a world where the marketplace lending model is leveraged?
Well, I think you hit on it a little bit at the beginning. I think the great thing about marketplace lending is it's bringing capital into the industry that that wasn't necessarily there before in that form. So I think the future of the industry and marketplace lending. I think marketplace lending will not be the be-all and end-all funding strategy for the industry, but it's certainly, because it's bringing more capital in and it's allowing more people to participate in the market, it really supports the growth of the industry, and it supports it really supports the ability to originate different types of products that may not necessarily fit the box. So I think it allows you to broaden out the product mix, because investors are looking for different things. New investors coming in with a huge influx of capital, it allows you to create products that sort of tailor those individual investors, time horizons, yield needs, et cetera.
Yeah, we've actually seen that even just on, a platform like Lending Club, which, as I mentioned earlier, I mean, they're doing consumer installment loans. It's not really that interesting of a product, but when you look at the yields of the different loans that they're issuing, we have clients who are only interested in the really lower yielding stuff because they're very sensitive to risk and credit. But then we have other clients who are, buying the higher yielding stuff. They're more interested in yield, like we were talking about the investors that you know. And the amazing thing is that all of those loans are being bought from the same place. And all of those borrowers who really have a different credit profile only had to go to one place. So really there's efficiency created, like I think all through the chain, which is, which is good. The efficiency is obviously better, it takes out cost, but on the borrower side, it does enable a borrower to go to one place, and because there's a diverse capital source behind that, there's more of a likelihood that they're going to get the loan, even if it's, dependent, it's just going to be priced differently. So you think that that by introducing marketplace lending, it makes capital more readily available to businesses and people?
It does. It doesn't come without risks. Because I think one of the things, and I've heard it a bunch already this morning, is there's a bit of a frenzy around marketplace lending. It's a new thing. A lot of people are talking about it. And there are lots of entrants into the market that may not have fully built out their origination and credit models. There may be guys who aren't providing transparency in what's being sold. So I would say, as with any new phenomenon that's technology driven, there's risks. And from an investor perspective, when I talk to investors, I try to talk to them about how do you evaluate what you're doing, and you really should evaluate the quality of the company, the quality of the management, their track record before you get in. I think that's the flip side of anything that's new and growing fast and has a lot of capital flowing into it.
Right. Yeah, and so at Orchard, that's something we see as well. And given that now we've been in the market for going on 2 years, we speak to loan originators of all kinds, and we definitely have conversations with somebody who's starting a consumer online origination platform in about 6 months, and they haven't made a loan yet, and they don't really know why they're doing it, and that's just not a platform that we would necessarily want to be interested in working with. We think it's really important for there to be a track record. How you build that track record, depends on your business, but we do think that that's important, and that's important to our investors. It's hard to, understand an investor who would buy loans necessarily from a lender who's just never done it before, right? We see that happening more, lenders being able to get up and running by giving an equity stake in their business to whoever's also buying the debt, which I think is a good model, because that way there's sort of, they're able to be involved in the growing of that business. But our focus is really bringing on more firms like yours who have a proven track record, are willing to share the data, and know what they're doing. So, very good.
We have time for a few questions.
Up here.
Angela, can you speak to transaction processing and funding settlement part of your system?
What was that? I'm sorry.
Transaction processing and funding settlement. So you put the information on your website, and people see it, they like it, they want to buy it.
Mm-hmm.
So they make a buy decision.
Yeah.
What happens next?
So that depends on the originator that we're working with. So with, right now with most of the people we work with, that all happens with the originator, between the originator and the investor.
So there's a direct link between the two of them. It doesn't go through your system, the settlement.
Correct. That's our business model right now. Like I said, we're a couple years old, so that's something that we may work on in the future. But right now, that's the way it works.
Okay, thanks.
So the investors, are they buying, you know, onesie, twosies, threesie, foursies, or millionsies?
Again, it depends on the investor, you know, I mean, our platform can support an investor of any size, so we have certain, you know, larger investors who are buying millions of dollars worth of loans every day, and then we have other investors, smaller ones who, you know, might be more onesie twosies.
I would sort of add to that, you know, from our perspective, you know, we're not allowing sort of accredited high net worth individuals. It's all institutional investors. So while they're making individual loan decisions by onesies and twosies, most of them are, you know, looking over time to buy significant volume.
Correct.
How much dynamic pricing do the investors have in this? In other words, is it just an immediate buy-sell decision? I either want to buy it or I don't want to buy it at a set price? Or is there a possibility of an option type component or reverse auction? Or
Yeah.
how sophisticated is that become?
So right now, the price is set and the buyers buy it at that price. We believe that for this market to really evolve, there needs to be dynamic pricing. It's just not there yet. But yeah, that's the future that we see. I think that's, you know, that's the way a market should operate, and that's the only way to really scale it.
Just to clarify, is Orchard the actual destination, or is it just a technology platform that if I'm already signed up with Lending Club or On Deck that I can use to filter for me my heuristics and make my purchases, or are you guys the actual destination where I'm having access to various networks of the platform?
Well, it's both. So if you already have a Lending Club or On Deck or Mainspring, any portfolio with any of these firms, you can come to Orchard and we can bring you on and help you manage that. But you can also come to Orchard and then have access to all of those.
Because for originators in leasing, pretend who want to allegedly do marketplace lending,
Yeah.
they need to put it on a marketplace. So do they need to sign up at one of those sources, or by tying into your system, are they automatically have, you can have marketplace all day long, if no one's gonna ever see it, then it's not gonna do anything.
I understand. Yeah, so an originator is a client of ours. And so we would work with the originator to bring their loans onto our platform. And then the Lending Club model today, the investors go directly to them because that's the way they set it up. But as we bring on new originators who maybe don't have a distribution process yet, that can all be managed by us as well. So we have originators who we work with who don't really have any interaction with the investor. We set up the investor account, we give them access to the loans. It's sort of up to the originator how they want to manage that.
Thank you.
Just had a question around the separation of the underwriting from the actual investment. So the person who takes on the risk of the investment is not the one underwriting each loan. Like, you feel like over time that changes underwriting standards? Or you feel like because you've been doing this for 5-10 plus years, it's something that will sort of stay grounded?
So my thinking on that is that because where the market is going is at a loan level where essentially an investor chooses the loan they want to buy based on transparent available data, that if the underwriting platform itself changes their underwriting strategy, that doesn't necessarily change the loans that that investor buys. So an example would be on the consumer side, FICO, we're all familiar with that, right? If a underwriter decides that they're going to loosen up their FICO and go down from, let's say, 700 down to 650, as an investor with an active strategy, you could still set your bar at 700. So the originator goes down, but you don't have to buy those loans. So that's sort of the unique feature here. And then the other piece is back to the dynamic pricing that you mentioned, is that as that gets involved with with having the data and transparency and being able to run real-time analytics on every loan that you buy, you would also be able to adjust the price of, once that gets introduced of the loan, which then can also mitigate that risk.
And I might just add that I think to your point, it becomes a bit of an iterative process because you may change your underwriting to develop products to serve the marketplace, but you're also reporting the performance of those products. So you've got to create something that somebody will buy and provide transparency to what's out there and underwrite that loan, in such a way that it meets kind of the risk parameters and the yield parameters that the buyers are looking to buy. But at the end of the day, if that loan doesn't perform, that segment of loans doesn't perform, then that's sort of your feedback loop to say you got out of whack on the underwriting side.
Ron, this question's for you. When you started to go to marketplace and started to sell your paper, basically, did you find any brand diminishing or any brand impact yourselves? Meaning that, if your vendors or any intermediaries bringing you business started to see that now that you're on a marketplace or sort of an internet portal selling your deals, did they start to say, well, hey, hang on, is something going on with Mainspring? Why are they not using traditional channels to securitize themselves and raise funding? They're now online selling their deals. Something might be going on.
Yeah, I think as everybody in the room knows, it's a small marketplace, and it does, people do understand what's going on. I think we're concerned a little bit about the brand relative to, our origination companies, which is really why we created a marketplace. Mainspring Funding is really the entity that runs the marketplace and gets its products from our portfolio companies. So that's really the sensitivity around the brand. We haven't really seen a diminishment of the brand per se, but it's still relatively new. We get lots of comments and feedback. I'm not sure that's had a big impact, but we were concerned enough about it that we did create them. And that's really the reason for creating the Mainspring Funding brand as it relates to the marketplace, is to keep it separate from the origination companies that are out on the street.
And sorry, go ahead.
I was just saying, and part two of that is when you are on the marketplace and you're selling, is it the stream of payments that you're selling and you're keeping the assets under management? Just like,
We're selling stream of payments, so we're retaining servicing, and I think that's an important component because it allows us to continue to post all the performance data and kind of real time. When a payment's made, we can update the site and they can see it, and that real time interaction for the investors is important. So it becomes really essential to retain the servicing, because if you don't do that, part of what the investors want to see is the upfront transparency, but then equally important is the ongoing transparency, so that anybody within one of these investment firms can look at really at any given day and see how their portfolio is performing.
Follow on to that, Rob. Two questions. One is just trying to understand, you'll post to the I'll call it the network, and is there some time period that you have in mind where you either want somebody to come in and buy, or if you're not filled, so to speak, you'll take it back to a traditional channel? Is that how you operate?
Yeah, I mean, it hasn't been an issue thus far. When we set up an orchard, fairly arbitrarily we set a 30-day time frame. That we didn't really want to tie up the loan that we were going to, if it didn't sell in the marketplace, the thought would be we could take it down after 30 days. That hasn't been an issue, because I think that one of the dynamics in the market is there are a lot more investors than there are assets for investors right now. So, but I sort of think of it as 30 days, holding it out there. That should give plenty of time for people to see what's going on. In the small business world, it hasn't gotten into the what's going on in the peer-to-peer consumer world, where it's people are making those decisions, and it's like high frequency trading for consumer loans on the. We're certainly not there yet, because there are more data points. A lot of people are still building models to look at it, but I think 30 days is a reasonable time.
And since it sounds like the network refers buyers in, you're not you're not you're not closing the transaction. So you could have interest from 3 different buyers that come through email or routed through the network. So you could have multiple buyers for the same loan schedule or lease schedule.
When a loan is posted on Orchard, that's the only place it is. So there wouldn't be an example where the loan is out on our platform, but also being emailed around to other buyers.
No, I understand that, but if there are 3 buyers on the network that saw the loan, and
Whoever gets to it first.
whoever the first one. Okay, and then is the history, Rob, in terms of this idea of transparency, you put something on, and is the idea that you'll continue to post the data on the performance of that loan over its course for the benefit of the other buyers, whether or not, just as participants, whether or not they bought?
Correct. Once we sign up investors, and give them access to our, to our loans and our history, they'll be able to see the performance, both our historical performance kind of pre going on the marketplace, but then the actual performance of every loan that's been on the marketplace. It's that transparency, I think, that gives people comfort that everybody's got the same data that they're using to make the buying decisions, and it frankly keeps us honest from what we're doing from that perspective as well.
Along that same line, this is obviously a new marketplace. Have the regulators been sniffing around this area? I mean, it seems there's a lot of transparency, but there is a lot of kind of secret black box around technology and how the information is handled. And just wondering if, I know there's a lot of banks here who are heavily committed in terms of how we handle the data, who sees the data, how it's kept, how it's secured, and it just appears to me that there's a lot of ways you can see this, especially if you're not a qualified investor, that could disrupt, privacy issues and things like that. So I guess the question is, are regulators looking at this closely and trying to understand where the risk is and protect investors, in the marketplace?
Yeah, I mean, certainly, as you point out, there are many, when you're in this world, there are many regulators who are going to look at it from the security side as well as the banking side. We have not put or asked our bank investors that we sell to today to go to that marketplace. So we don't have any feedback from the bank regulators, and so really, you're really back into privacy concerns and management of that data. And again, we've chosen initially to just stick with institutional investors, so we're not going through the whole accreditation process, which has become an important component of the consumer world. I think my view on that is let's let that shake out a little bit in the consumer world before we open it up, and that brings a whole host of other concerns.
We're going to take just about 2 more questions, and then I'm sure Angela and Rob will be more than happy to answer anything else back in the exhibit hall.
Very interesting presentation. In terms of your average ticket size, could you give us an approximate size, and also in terms of your credit turnaround time, what that typically runs? Is it as fast and rapid as what you see on the consumer side of it, or do you have to wait for an investor to say yes and it's credit approved?
We're actually approving and funding all the loans before we put them up on the platform. So we're not putting any sort of open credit requests up on the platform to see if they will get funded. So from our perspective, we're still making the decisions the way we've always made them, funding the loan, and then once the loan's funded, then we put them on the platform.
And your approximate average ticket size?
50,000.
Okay. And one last question: if somebody doesn't pick up that transaction on the Orchard distribution, do you retain that transaction?
Yeah, it hasn't happened yet, but if it does, we'll pull that transaction back down and either retain it on our balance sheet or offer it out to one of our traditional investors.
Thank you.
wanted to ask you a question about pricing. The investor makes what it makes on the purchaser of that loan. How does the originator make money in this process? Do you reprice the loan? Is it all through the servicing?
Yeah, so most of the originators we work with make money on like an origination fee and then a servicing fee. There are some originators that do sell their loans above par, so they can make money on that as well.
And then, if it's not picked up the first time, I understand it's not happening in your case, but is there an opportunity for the originator to then reprice that to see if they'll sell the different price?
So you mean put it out there at one price and then
It doesn't get picked up for 30 days. Now,
Yeah.
they can do that.
Yeah,
So there's flexibility.
absolutely, yeah.
Although it's not an auction process, you could.
There's no auction process, but yes, so you could do, yeah.
With the blue light sale on.
Can everybody help me thank Angela